Yeah, so I think the market's been a little bit aggressive here, maybe getting a little bit ahead of where the Fed actually is. Like you said, we heard from Evans, we heard from Powell, and they're talking about flexibility. They're talking about the potential to react if we see some of these downside risks emerge and be realized, but they really haven't been realized yet. So I think we're right now kind of waiting, watchful, and markets maybe getting a little ahead of itself, a little pessimistic here.
Lizanne, what did you make of the comments from the Fed chair this morning? How significant are they?
Well, I would agree with Andrew. I think it set the stage for the potential to consider that, but I still think that the bar is fairly high for rate cuts here, particularly the 3 that are anticipated over the next year by the market. So I think you'd have to see it impact the actual data versus just through the confidence channels, which is where we have seen the impact felt most severely and beyond just the day-to-day volatility associated with trade headlines. So I think the bar is still fairly high for multiple rate cuts.
And at the same time, Chris, we have a president who's reiterating his desire to impose tariffs on Mexico this morning. He is not backing down on that front, even though, as they say, Congress may be trying to interfere. So if you were looking from the market's point of view for relief on that front, you're not necessarily getting it yet, are you?
You're not indeed. I think the president, in fact, doubled down this afternoon or this morning in his press conference with Prime Minister May. This is a time where you would have expected the leaders of the UK and the United States to sort of provide some reassurance that growth and markets would get some policy support. And you have Prime Minister May headed for the exit door, and you have the president sort of saying we haven't really begun talks with Mexico yet. It's probably going to get worse before it gets better.
What do you make of this idea, Chris, that Congress is going to block it? I mean, they'd still have to override his veto, presumably.
I think it's a very, very long shot at this stage. The president has wide discretion to reach for a national security justification for these kinds of tariffs. I think it's an enormous departure from past presidents and from any sort of traditional approach to trade policy. We're now sort of saying that not only is any country vulnerable to tariffs if we're going to put tariffs on Mexico, but any country is vulnerable for almost any policy reason. So I think if you're a long-term investor, if you're trying to plan ahead what your addressable market is going to be overseas, what your supply chain is going to be overseas, you have to take a lot of these things into account. And those are building headwinds for the longer term.
And Andrew, that's why I think we've seen a lot of people mark down their forecasts, partly on uncertainty, just saying, look, the cumulative effect of these tariffs is going to slow down the economy in the back half of the year. Why are you guys more sanguine? Or are you sanguine, or is it just that you don't think things are so extremely bad?
I wouldn't say that we're sanguine. I mean, these uncertainties have definitely increased, and we take that very seriously. And so I completely agree with the commentary that we've had from Fed officials that we should be watching these, closely monitoring them. The issue is that you haven't really seen it impact the real economic data. We're still in a pretty good place in the U.S. economy. Look at strong job growth and a consumer that's strong. And it's not really economic data that would be calling for a rate cut right now. So I think you just want to be a little bit careful if you're the Fed and not move preemptively when you haven't actually seen that data weaken yet.
And finally, Lizanne, for those who are saying, but look at the yield curve, 7 out of 7 times we've seen it happen this way for more than a year. We've always gone into recession. I mean, you see these headlines. What about them?
I think the question right now with regard to the yield curve is this one of the 7 times that it has been an accurate forecast or within, call it a year of a recession, or is this a 1998 situation where you had a brief inversion, you had a crisis, which some might liken the trade situation to the crises back then within Russia, the Asian currency crisis, the fall of long-term capital management. Does the Fed cut purely because of that crisis, and in turn it elongates the cycle, although not very far? You ultimately peaked out in 2000 with the market, and you did get your recession. So I think that's the valid question to be asked at this state in the yield curve inversion, which has still been short-lived.
No, in that experience.